So let me bring to the show Juan Perez, FX strategist at Monix USA, formerly Tempus. Good morning, and thank you so much for joining us, Juan.
Good morning, Alex. Thank you so much for having me.
I was wondering, do you believe that the stock market is likely to budge the Fed tightening, or the Fed is focused on inflationary pressures?
Well, I mean, everybody is looking at their retirement funds, right? And trying to make some short-term and long-term decisions. It seems like assets all across the board are kind of worried. And, obviously we have to talk about the Federal Reserve. It seems like they are determined to address inflation. I truly doubt that once they meet tomorrow that they will deviate too much from what they've been saying. But the thing to watch out for, and I think I mentioned this last time when I was here, was really the tone of the Federal Reserve. We have to take into account that even during Jerome Powell's his testimony to the Senate Banking Committee, and as he was trying to explain why he should continue for another term as the head of the Federal Reserve, he did mention that indeed this year was going to be tough. And I know you and I only spoke a few weeks ago, just at the very fresh beginning of the year, but now it doesn't feel so fresh. January is about to end, and it certainly was a very turbulent month in which, like in my opinion, we do have to put into doubt this Bank of England Federal Reserve determination to really start increasing borrowing costs because they're so afraid of inflation. So what you have to watch out for tomorrow is really that tone, whether, now that PMIs have come out, now that and really Friday we're going to get the gross domestic product and really numbers for the fourth quarter that are really going to give us a clearer picture of how much of a negative effect the Omicron variant had. The Federal Reserve could potentially sound, hesitant, and could kind of give a bit of a hint of maybe we could delay. And if indeed that materializes, which I think it's possible, maybe the dollar is not going to skyrocket. Maybe there isn't going to be that much movement because it is priced in that they do want to increase interest rates, that they may do it as soon as March. We'll see how confident they sound tomorrow in saying that. But ultimately, stocks are worried not because just the Fed and the easy money that's kind of going away, because in Japan, China, and in the European Union, there seems to be a stimulus mode still playing into the mentality of those regions. But now, as a world, we have to be concerned about Russia. We have to be concerned about Ukraine. We have to be concerned about any type of conflict and situation that creates and exacerbates problems that we already have with supply shortage. So we have to think about the world economy now, not so much in terms of what the Fed's going to do. Now we have to think about what the Fed's going to do, the lack of easy money, and at the same time, the repercussions that there could be if indeed there is any type of conflict in which NATO and Russia need to start addressing it seriously.
Right. On the other side, ahead of Fed meeting, we do see the dollar index pretty stable, up about 0.3% in 96.19. Euro dollar heading south of about 0.5% at 1.1272. What's the most likely scenario in the very short term for the euro dollar? And certainly, how do you explain this strength of the greenback?
Well, so basically, when it comes to the euro-US dollar pair, we are back at the weakest level for the euro since December 21st. So basically, for what's happened for the past month is indicative of what we've been writing and talking about, that there still remains a tremendous amount of uncertainty. And ultimately, as I had mentioned before, there was before more of a consensus in the European Central Bank about the desperate and dire need to really help and to ask also for the fiscal side of things to step up and help the economic recovery. But the economic recovery is now running into not only the central bank divergence, which does favor the US dollar and yields if indeed interest rates do go up, but this idea of Russia making things more difficult as they are. Obviously, in the middle of the pandemic, part of the industrial growth has to do with the ability to get shipments of natural oil and supplies of gas. And if this is going to be another element of turbulence and another factor affecting the economic recovery, then the European Central Bank is in all its right to to maintain this mode of saying, hey, you know, we kept this wait and see approach because we felt it was the right thing considering the unprecedented effects of the pandemic. But at the same time, we have to worry about that the economic recovery is now in danger because of this threat. So ultimately, like I said, you know, for the euro to be in the levels that it is in the 112s and not be sinking into 110 shows how resilient the currency is and how much it is priced in, that there are factors there that, you know, there's policy divergence, that interest rates might go up in the United States, that they may not go up and be hiked at all in Europe. But ultimately, if the euro didn't fall into 110 or really deep levels, considering that there is an equity market correction and there is a potential for physical conflict, I think that the euro will be resilient, will probably stick around these levels, probably fall into maybe the high 111s or low 112s just out of fear and concern. But at the same time, once the Federal Reserve and once these numbers for Q4 come out, I think the mode that we're going to be thinking is economic recovery. And if economic indicators are good enough for the Eurozone in Q1, there should be reason and merit for the euro to go up. And of course, if that increases any talk about hikes in the future for the ECB, then even more credit to the euro. But it's hard to tell exactly how much of an effect until we see numbers, especially towards the end of this week and after this week.
Thank you very much, Juan Perez, Monix USA. Thank you for joining us and have a great day ahead.
Thank you so much for having me.